Well, hello there everybody, this is Morris, and in today's class we're going to be talking about trading volatility. It's one of the most crucial, if not the most crucial element to trading options. So pay attention and learn some good trading tips. So trading volatility is the most crucial part to options trading. The most successful traders understand its importance and give themselves a chance to profit long-term through options. Those who do not have very little chance of succeeding. Studies indicate that volatility accounts for 6 times the profits and losses related to options than theta. Again, that's very key, so listen once again. Academic studies indicate that volatility accounts for 6 times the profits and losses related to options than theta. So again, when you're trading options, it's going to behoove you greatly to understand volatility as well as you can and trade with it, not against it, because those profits and losses are made from volatility much more than they're made from theta. If you're concentrating on theta alone and you ignore volatility, then most likely long term, you're not going to have success with trading options. Next, we'll talk about how to actually master volatility trading. To master volatility, you must master the Greeks related to volatility. Makes sense. Number 1 is Vega. Number 2 is Vomma, and number 3 is Vanna. There's another Greek related to volatility, actually a couple more. One is Vega, but we're not going to talk about that today. That's how your Vega changes over time, but since it's a slower indicator, it's not necessarily as important to learn as your Vega, Vomma, and Vanna, which are instant, and they're always right there, actively participating in your portfolio. So you have to understand Vega, Vomma, and Vanna. And again, your Vomma and Vanna are used to manage your Vega position. So if you're trying to manage your Vega, but you're not using Vomma and Vanna to do it, then you're at a serious disadvantage. Next, we'll briefly discuss what these Greeks are exactly. So your Vega is the portfolio's profit and loss changes relative to the volatility changes of the underlying product. Number 2, your Vomma represents the changes in Vega relative to the changes in volatility. Number 3, your Vanna represents the changes in your Vega relative to the price change of the underlying product. So right away, hopefully you can see why it's so important to understand Vomma and Vanna. Again, if the trade has, let's say, a specified Vega position, let's say it's negative. Let's say you have negative 100 Vega, and the volatility rises. Well, that Vega position is going to change depending or according to whatever your Vomma is. So if you happen to have a negative Vomma and volatility goes up, then your Vega position is going to go backwards. It's going to go exactly the way you don't want it to go. If you happen to have a positive Vomma, then your Vega position actually dynamically changes in your favor as volatility changes. So if you can configure your trades with a positive Vomma, then that has a serious advantage, and your Vega position can dynamically adapt in your favor as volatility changes. Number 3, we'll talk about Vanna just a little bit. So again, as the underlying price moves up and down, your Vega position is also going to change. If you have a position with a positive Vanna, then guess what? Your Vega position changes the wrong way. If you have a negative Vanna, then your Vega position can change the proper way. So once you understand these concepts, you'll see just how important they are to understand. If you're trading options and you're not managing your Vomma and your Vanna, again, you're at a serious disadvantage because your Vega is just going to be most likely shifting the wrong direction for you relative to volatility and price, and your losses are going to accelerate relative to price and volatility changes. Next, we're going to talk about a strategy called the put front ratio, and you can put it on for a net credit. So we want to look at this a little closer and look at those internal Greeks to see if the put front ratio for a net credit is a good trade setup to profit from volatility. The internal Greeks, the internal Greek attributes related to volatility. Again, the Vega position of this trade is negative. The Vomma position of the trade is negative. The Vanna position of this trade is positive. What does that mean? Well, in this trade, when you break it down, the three Greeks relative to volatility are all detrimental to this trade. This is exactly what you do not want to do. Let's see why by looking at an interactive risk profile of this trade structure. So here on the screen we have a put front ratio spread, and we built this one near the money. It's actually a 2-by-1. So we have 2 short contracts for every 1 long contract we have. This entire trade is built of puts, and again it's structured around 2 different contracts. Let's take a look at the structure. So as we look at the spread box here, we can see that we've sold 20 at the 20-30 strike, which is approximately the 24 delta, and we're purchasing the long contract around the negative 44 delta. Both of these are negative, these are puts. This trade is out approximately 52 days, which you can see right here. The gamma of the trade is negative 1.24. Theta is very strong, but you see that your Vega position here is also very negative. Next, we'll interact with the chart so we can see how the Vega position works relative to the trade, how it's relating to the volatility changes as well as the price changes. So first let's observe the Vomma position. Okay, so down here, take a look at your Vega, and I'm going to increase the volatility, which is off the screen, but I'm increasing volatility. And you will see the Vega becomes more negative. Okay, so that started, let me reset it. It starts at 1832 negative, and as I increase the volatility, you'll see the Vega position get worse or become more negative. I'll explain why it's worse in a moment. Okay, so that represents that the trade has a negative Vomma position, which in this trade is detrimental to the trade, and I'll explain that in just a moment. Next, we're going to look at the position Vanna of the trade. As I told you earlier, the Vanna represents how your Vega is going to change relative to the price changes of the underlying product. Notice as I move the mouse to the left, again, keep your eyes down here at the Vega, you're going to see that the Vega also becomes more negative. That's caused by having a positive Vanna position on the trade. Okay, now as you can see, your Vega position here is negative. So once again, let's go back to the slide. And here we see, again, the Vega is negative, the Vomma is negative, and the Vanna is positive, which I just demonstrated. Now all three of these Greeks are actually implemented into this trade entirely backwards. So it's about the worst volatility structure that you can possibly create for a trade, you'll find it's hard to create something worse. Now let me show you why. We'll go back to the risk profile. So back here at the risk profile, the problem with the trade is the correlations of price to volatility. And let me jump over to the price chart. So as a student of volatility, you want to look at your implied volatility. You may want to study historical and skews and things. But to simplify this, we're going to look at the price action and how it relates to implied volatility. Now again, here we're looking at the SPX and we see that they form an inverse correlation, or almost like a mirrored image of each other. Here as we have the price coming down, you see that the implied volatility is moving up. Here as the price is moving up, you have the volatility moving down. You have the vols going up, price going down, price moving up, volatility falling, and so on. This is what we call an inverse correlation. If you run the queries, you'll find that it's really, really high. It's like over 80% correlated. And then once the moves are larger, it jumps up over 90% correlation. Okay. You'll also note, if you do the math, for example, here we have about a 10% drop in price, and there's actually about an 80% increase in volatility through here. So you can figure out those correlations. And then you can use that information for your modeling on the risk profile. Let's go back to that. So once again, we're back at the risk profile, and we just looked at the price to volatility correlations, and now we're going to input the volatility increase into the Black-Scholes, and we're going to observe the risk profile, what would happen and what did happen in the past as the market moves down 10%. So we're going to increase the volatility about 9 points, which will correlate according to the past historical moves. Then I'm going to move the mouse down 10% and we'll see what actually happens here. So this particular trade, as you look down on the bottom right here, you're going to see the dollar amount that the trade actually loses. So this one loses a total of $99,000 from that same move that we saw in the past. Now, if you're using a portfolio margin account, we can also bring in the percentage loss by clicking here, and it's actually about 138% loss on that portfolio margin. So you just saw what would happen to this trade if the SPX moves down quickly like it did in the past, about 10%. Next, we're going to look at what happens to the trade if the SPX actually moved up about 10%, and we're going to apply the inverted volatility change. So this time I'm going to drop volatility 9 points, or 9%. And then we'll see how this affects the trade. So there's that 9%, just because vols are measured in percent, change in volatility. And then I'll move the cursor over 10%, and we see that it has a profit of $1,200. So you can see this trade, the risk to reward is about $100,000 risk for about a $1,200 gain. Okay, so let's just wrap it up. if we're looking at this trade, well, number one, be extremely careful. I highly actually would encourage you not to ever put on this type of trade, because as you see, the three elements that are used to manage your Vega position, or the way this trade will relate to changes in volatility, every single one of those attributes are configured backwards. Your Vega's backwards, your Vomma's backwards, and your Vanna is also backwards. So again, what happens is you end up with a trade like this that is risking about $100,000 with a decent move to the downside, where it's only going to profit about $1,200 if you move up. Okay, now the trade looks like it's right next to this, which is your expiration risk profile, but don't be deceived by that. When the market moves down, it moves a lot faster than it moves up. So the odds of you finishing like right in here without an increase in volatility are pretty slim. That's only like a 3% move down in a month, and it's not very likely to happen. So don't be fooled by that. And then also, don't consider this trade as a hedge, a downside, a bearish hedge, because it's not. You can't rely on, again, a month or 2 months passing and ending up perfectly here. That's very unlikely to happen. So if you're considering this type of trade as a hedge for a stock or a long position, it's would hardly ever work, maybe 1% of the time. Because when the market goes down, again, it goes down fast. As you saw, there's an increase in volatility. So if you're trying to use this particular position as a hedge, you're going to lose on this one, and you're going to lose on your long position at the same time. And you're just going to have an unhedged position overall, and you're going to lose on both of them. Okay. The other thing very important to point out is your margins on this trade. If you're trading portfolio margin, are going to increase tremendously. So again, if I increase the vols 9 points, for example, the trade in this case started with a 72,000 margin, but you go down, if you come down 10% and then they measure down another 10%, you're looking at the new margin would be over here, which would actually change to about 279,000. So essentially this trade could start with a $72,000 margin based on common portfolio margin calculations. But then quickly this can change to a margin of 279,000. So that's about it. Hope you found some helpful tips about the put front ratio and about trading volatility. And again, this is exactly what you do not want to do. If you want to find out what to do, maybe you could do something backwards. Or again, visit us at sgoptions.com, sgadvisor.com, and we'd be happy to show you how to trade volatility with all of those Greeks in your favor.